February has seen some mixed performances from key equity markets. However, the leading UK index hit an all-time high in the past 4 weeks. The reason is that this index contains a number of defensive stocks that are less impacted by the economic climate, along with some companies that provide some inflation proofing. There's also a dependable dividend yield. Interestingly, the majority of its earnings also come from overseas, where the strength of the US dollar against sterling has made those revenues more valuable when they are translated back. So turning to US growth assets, the Fed minutes from the FOMC meeting, this is where the Fed sets interest rates, at the start of the month were released, and this set the tone for the rest of February. The key takeaways were that inflation remained well above the Fed's 2% target, and labour markets remained very tight and contributed to continuing upwards pressure on wages and also prices. The markets had started to factor in a reduction in interest rates this year, but on the back of these minutes, this seems now less likely, and we saw both equities and bonds fall on this news. Consumer and personal spending data in the US also seem to support this view. So keeping with inflation, the 24th of February marked the 1-year anniversary since Russia's invasion of Ukraine. And the impact of this ongoing conflict continues to be felt around the globe and has put huge pressure on commodities like fuel and energy. And of course, this has caused prices to surge. Now, this has been coupled with supply chains that were already under strain post-COVID, and this has added to the reason why the inflation story is still strong. Returning to factor performance, over the month, the factor that produced the best return was momentum, whilst the growth factor suffered once again. And on the back of this growth factor underperformance, ESG portfolios were impacted over the month as they remain biased towards growth stocks. Moving to defensive assets, the change of outlook on inflation weighed on bonds, and this meant both the UK and the US 10-year treasuries decreased in value as yields rose. This takes these two benchmark bonds back to where they started at the beginning of January. So in summary, the inflation interest rate noises are continuing to set the tone for global markets as we move closer to the end of Q1. An all-time high level in the UK index has helped sentiment, but the test in the short term will be whether this index can hold this level as we move through into March.